Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast, episode 265. Hi, I'm your host, Jacob Ayers. Welcome back to another Friday Fundamental. This week's Friday Fundamental is cash out refinances. Well, real estate investing is kind of cool, I like to think. From building long-term wealth to generating residual passive income, there are some really powerful benefits to investing in real estate. One of the things that make real estate so attractive is the ability to leverage debt. Now, when most people hear the word debt, they automatically think bad. We're told to avoid debt where possible, pay off debt as fast as possible, and become debt-free. Used wisely, debt can be a tool that maximizes your wealth and income. Used incorrectly and, well, it goes the other way. Good debt and bad debt, as Robert Kiyosaki defines them, are as follows. Bad debt is debt that you have to pay yourself, typically on liabilities. In this context, liabilities are anything that takes money out of your pocket every month. Think car loans, credit card bills, etc. Now, good debt, on the other hand, is debt that someone else pays back for you, typically on assets. Assets opposite of liabilities are things that put money in your pocket every month. Think investment properties, dividend-paying stocks, businesses, etc. Using debt to purchase income-producing real estate can be a great thing that magnifies your return on investment. Anytime that you can achieve a higher ROI by using debt than you could without is good leverage. Let's look at an example of how debt can impact your cash-on-cash return of a rental property. In scenario 1, we're going to make an all-cash purchase. You buy a $50,000 rental property without using debt. This means you buy the property for all cash. The property rents for $500 per month. Your expenses for insurance, taxes, maintenance, and management total $200 a month, leaving you a monthly cash flow of $300 or $3,600 per year. Now you take that $3,600 of annual cash flow divided by your initial investment of $50,000 and you get a 7.2% cash-on-cash return. Now here's scenario 2 where we use debt to buy the same $50,000 rental property. With a 20% down payment of $10,000, you borrow $40,000 at 4% for 30 years, which is a typical fixed rate mortgage. The property rents for $500 a month, same as scenario 1, same expenses, $200 a month for insurance, taxes, maintenance, and management. But in this scenario, we have a mortgage of $191 per month. So $200 of expenses plus $191 for a mortgage equals $391, leaving $109 per month in cash flow, or $1,308 per year. But in this scenario, we used a down payment of $10,000 rather than forking over the entire $50,000 for the purchase. So we take our $1,308 divided by our down payment of $10,000 and we get a 13.08% cash-on-cash return as compared to the 7.2% cash-on-cash return in scenario 1. Now, even further, let's look at appreciation. Let's say the $50K property appreciates at 5% to a value of $52,500. This is a gain in equity of $2,500. Now, in scenario 1, where we purchased the property for all cash, we have a $2,500 in equity gain divided by $50,000 is 5% appreciation. However, in scenario 2, where we used debt, we have the same $2,500 in equity gain, but divided by our $10,000 down payment is a 25% gain on appreciation. Notice here that the amount of equity you have in your property does not matter. The property appreciated regardless of your equity position. Both scenarios have the same appreciation rate of 5%. However, in scenario 2, using leverage, your return is 5 times that of without using leverage. As my good friend Keith Weinhold from Get Rich Education says, the rate of return on equity is and always will be 0%. Alright, so that's the case for using debt to invest in cash flowing real estate. Let's talk more about how to keep your money and, more importantly, other people's money working for you. Knowing now that the rate of return on equity is and always will be 0%, we want to manage and minimize to a certain level the amount of equity we keep in our investment property. This can be done through several ways, one of which is doing a cash out refinance. A cash out refinance is simply taking out a new loan on your investment property, paying off the original loan, and pocketing the difference. Let's look at an example of this. Let's say you buy a duplex for $55,000. With a long-term fixed rate loan, you put down 20% or $11,000. Through a lot of sweat equity and hard work, you fix the place up, paint the interior and exterior, update the hardware and finishes, and do some kitchen and bathroom upgrades. You now have the property looking good and fully occupied, with each unit renting for $550 per month for a total of $1,100. 2 years later, you realize that the properties in your area are selling for much higher than you bought yours just 2 years ago. Most of this is due to you buying the property off market and partly due to an appreciating market. Knowing that you likely have a significant amount of equity in the property, and that is what it's worth minus what you owe, you decide to explore a refinance to capture some of that equity to put to work in another property. So after talking with your lender and applying for a new loan, the appraisal for your property comes back at $110,000, coincidentally 2 times what you paid for it just 2 years ago. This means that you have significant equity in the property. Now, some would think to pay down the property and be debt-free, but all that equity is trapped in the property and then not working for you. As the savvy real estate investor you are, you want to capture that equity and roll it to another property. So you are able to refinance your property, leaving a healthy 30% equity position and borrowing 70% of the $110,000 appraised value. This means the bank will lend you $77,000, which you use to pay off your existing loan of $43,000. It started at $44,000, but you've since paid it down over the 2 years to, let's call it $43,000. So you take your $77K refinance, pay off your $43K existing loan, and are left with $34,000 to use at your discretion. You could go to Cabo, buy a new car, or roll that money into another investment property. Doing this, you are maximizing the velocity of money while using the power of leverage. This is how you can snowball your real estate investment into a real estate empire. Using debt, maximizing leverage, controlling more assets, and taking on good debt are concepts that may seem counterintuitive at first. but so is being wealthy. To be wealthy, look at what other wealthy people do. If this sounds unusual to you, I encourage you to think more about it, talk with other people who have built real estate portfolios, and see for yourself how using debt to buy cash flowing real estate can help you build the life you want. Well, that wraps up this week's episode of Friday Fundamentals. Hey, I hope you're getting value from this podcast. If you like what you heard, please go over and leave a rating and review on whichever platform you're listening on. As always, for more information, resources, and to connect with me, you can visit www.jacobayers.com. Till next week, engineer the lifestyle you want.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.